Good. We are going to do the change in estimate, which is IAS 8. We're only going to do a part of IAS 8. The rest of IAS 8 is all about changes in fundamental errors. If I've made a fundamental error, what should I do? How do I reinstate or restate my accounting figures? But we're not going to do that. That you're going to do next year. So the only portion of IAS 8 that we're going to do this year is where there was a change in estimate, which has something to do with PPE. Now, I'm sure you know this guy. He says, nobody is a better accountant than you. All other accountants are total disaster. Everyone agrees, believe me. So believe in yourself. That is the way to go. What do we want to achieve by this study unit? Now, the first thing is we want to do a change in depreciation estimate calculation and the recording thereof in the accounting records. And then obviously, because we're busy with financial accounting, we should know how to disclose changes in estimates in the accounting records. Now we keep on talking about estimate calculation, estimate disclosure, estimate whatever. What is the estimate? Now guys, if you think about that logically, what is depreciation? Depreciation is where I write off the cost price of an asset over the estimated lifetime of that same asset. Now, there are a few estimates that I make whenever I decide how I'm going to depreciate an asset. The first thing that I have to estimate is what is the useful life of this asset? Or if I'm using the production unit method, what is the total capacity of this asset? So that is the first thing that is a bit dodgy. I'm not 100% sure. The next thing that I have to estimate is, if you think about that, we are depreciating the depreciable value of an asset. And what is the depreciable value of the asset? It's the cost price of the asset less the estimated residual value of the asset at the end of the asset's lifetime. Now, let's say the asset has a 5-year lifetime. Guys, a lot of things can change in a 5-year time period. Look at us now. We are now, 3 months, 4 months down lockdown, and look how your life has changed in the past 3 or 4 months. So you can just think what can happen to the estimates that we do in a period with a time span of 5 years. So it is not cast in stone. For sure, certain things can happen that will have a severe impact on these estimates that we've done. And then it will be really wrong to keep on working with the old estimated figures because we know better now. We know now that we cannot use, let's say, estimated residual value of 20% of the cost price of the asset because new assets came out, better technology came out, and probably we won't get a single cent for the old asset. So then to work with a 20% residual value and only depreciate our asset equal to 80% of the original cost price of the asset is not going to fly. It's not going to have a fair reflection of the value of the asset that we've used in order to generate income in the current financial year. So therefore, nothing in this life is static. Everything changes. And if things are changing to such an extent that it has an impact on the fair representation of your figures, you have to affect the change in your books. Good. Now, just a reminder, when does depreciation start? It starts when the asset is available for use. So at the date that that asset is in a condition that you can start using it, it's not to say that you are going to start using it, but that doesn't matter. What matters is that you're going to provide depreciation at the date when the asset was available for use. Now, obviously, when I work with a production unit method, it doesn't matter because then it works on the actual number of units that that asset has produced during the year. Now, what about idle time? Idle time, let's say, assume we bought the asset at the 1st of January. Our financial year end is 31 December. And it is the policy to close down the factory. Let's assume it's a machine and we have a factory It is our policy to close down the factory the whole of the month of December. The first 2 weeks we use in order to service the machines, do some maintenance work, etc., etc. And the last 2 weeks in December, the factory is closed for the summer holidays. Now, if I'm working on the straight line method and the diminishing balance method, then in those two instances, it doesn't matter whether that asset is not going to be used in December. So I will provide depreciation for the full 12-month period on that asset, depending on what method I use. The production unit method, again, doesn't matter because then it works on the actual number of units produced. And if I didn't produce anything, well, then obviously there is no depreciation on that. Now, let's assume that we have bought an asset and we have, after year 2, there is a change in estimate. Now, that change in estimate can either be on the amount of depreciation that we're actually providing on an annual basis, or it can be based on the estimated residual value, because that also has, or the estimated lifetime of the asset. All of those things have an impact on the depreciation charge that we're going to estimate on a year-to-year basis. Now, to affect this change in estimate, there are 2 methods, and it is of the utmost importance that you understand what the 2 methods are all about and how to calculate depreciation and how to do the disclosure under each one of the 2. If you're going to get all confused about the 2, you are going to fail, because this change of estimates will pop up not only in a PPE question. We combine that with companies, we combine that with cash flow statements, we combine that with IAS 1. So it doesn't matter what paper you're going to write this year, there will be a change in estimate in one of those questions. So therefore, it is extremely important that you understand what the 2 methods are all about and that you can apply both methods. Now, the reallocation method is only forward-looking. So you forget about the sins of the past, you forget about let bygones be bygones, you start at the beginning of the current financial year in which you're going to decide to do a change in estimate. And you look forward and you're going to affect the changes going from the beginning of the current financial year up to the end of the lifetime of the asset. So that's a reallocation method. The cumulative catch-up. Now, just look at those words and try to think in your mind, what does that mean? The fact that I talk about catch-up means that you will reflect on the past. So you're going to catch up all the sins of the past and you're going to restate all your figures as if you have applied the latest estimates as from the beginning, as from the date that you've purchased the asset. Here's a bit of wisdom for you. The successful man is the one who finds out what is the matter with his business before his competitors do so. So, let's look at figures and let me try to explain to you the difference between the 2 methods by looking at an example. Let's assume that we have bought a vehicle as at 1 January 21. The cost price of the vehicle was 100,000 Rand. We decided to write off depreciation on the straight line basis over a 5-year period. Initially, when we purchased the vehicle, we didn't estimate that there was going to be any expected residual values, and residual value is what I can get for the asset at the end of its lifetime. So at the end of the lifetime, I do not expect to get 1 single cent for this asset. And now, as at 31, our year end is 31 December. As at 31 December 23, we have now done a re-estimate and says, wow, we were a bit rigid in our estimations that we're not going to get a single cent for this vehicle. We will be able at least to get 5,000 Rand for this vehicle at the end of its lifetime. Now, we have recorded this vehicle as at 1 January 21. So at 31 December 21, we have made provision for 20,000 Rand of depreciation. So the carrying value at the end of 21 was 80,000. At the end of 22, we have provided another 20,000 of depreciation. So our accumulated depreciation was 40,000. Our cost price was 100,000. So our carrying value as at 1 January 23, the beginning of the current financial year, was then 60,000 Rand. Now we have actually come to our senses, and we've decided that we can get, at the end of the 5th year, 5,000 Rand for this vehicle. What is the value that it's currently lying into our books? 60,000 Rand. We would have depreciated that asset up to a value of 0. So 20,000, 20,000, 20,000, 20,000. Now, because we have an estimated residual value of 5,000, we are not going to depreciate this asset up to 0. We are only going to write it off up to a value of 5,000 Rand. The question that this entity has to ask itself is, yes, we have now established this fact, very nice, but what method are we going to use to record this change of estimate? And let's assume in the first place, they said, we are not fond of dwindling about in the past. Let bygones be bygones, we couldn't care less. Let's just look from the 1st of January 23 forward, and let's effect the change from now on forward. So that means we are going to use the reallocation method. He says what's done is done. No matter how much we want to change the past, we can't. So let bygones be bygones. What happened, happened. Dwelling on it won't change a thing. It's time to let go and reclaim your peace. So we're not going to wander into the past. We're not interested in the past. We are here, present, future. We don't care what happened in the past. Now the present that we're talking about here is the carrying value of the asset as at the beginning of the current financial year, the year when we decided to do the change in estimate, i.e. the 1st of January 23. And we're going to start there. That is our starting point. And we're going to start there and project this thing forward and write off depreciation on that asset, starting off with a carrying value, i.e. the 60,000 Rand, the carrying value of this asset at the end of, or at the beginning of the current financial year. So we said, well, if that carrying value is 60,000 and the estimated residual value is 5,000, how much depreciation must we still write off of this asset to derive at the estimated residual value? Guys, and this is not rocket science. 60 less 5 equals 55,000 Rand. So we still have to, from 1st of January 23, write off 55,000 Rand on the asset. And it's a straight line method, so it's evenly spread over the remaining 3 years. 2 years is past, so there's 3 years left as from the beginning of the current financial year. I can't stress enough that you always have to start at the beginning. Tell yourself that 5,000 times. The beginning of the current financial year, there's still 3 years left. So let's look at the figures. We said, well, the cost price of the asset was 100,000. We've written it off over a 5-year period, i.e. 100 divided by 5 equals 20% per annum, which gave us a 20,000 in 21, 20,000 in 22. So at the beginning, carry value at 1 January 23, that would have been 60,000. Our starting point with a reallocation method. So we say, okay, well, 2 years obviously is gone. We're going to write it off over a 5-year period. So how many years are left? 3 years are left. What is the depreciable value as at 1 January 23? Not 60,000. It's 60,000 less the estimated residual value of 5,000, which gives us 55,000. 3 years left. So how much depreciation do we want to pass? In 23, 18,333, 24, 18,333, 25, 18,335, and if I add it all together, it will add up to 5,000. And then I can get 5,000 Rand for the asset when I scrap it, and then it will be square in my books. Now listen to me very carefully, kiddies. When you do these change in estimates, make 100% sure you do it in this format. The old method, next to it the new method, next to it the difference column. Because if you do it like this, all the figures that you need for disclosure purposes is right in front of your eyes. If you're going to do that pages and pages and pages underneath each other, you are guaranteed not going to derive at the answer, and if you're going to derive at a answer, it's going to be the wrong answer. So listen to the old auntie, she knows what she's talking about. You do the old and the new method next to each other. The old method is the way that you have done in the past. Now you're going to carry on with that in the current financial year, although you're not going to record that. But you need these figures in order to do your disclosure. So therefore, we're going to carry on with the old method. The new method will obviously affect the change in estimate. Reallocation method, our starting point, our carry value of the asset as at the beginning of the year where the change in estimate took place, which is the 60,000 under the old and the new. We can't change it. That's a fact of life. It is in our financial statements as it was published for the year 21-22. So we can't now suddenly make it something different. That is our starting point. That is what we have. We cannot change it. It's 60,000. If we did carry on with the old way, we would have written off in 23 20,000 Rand, and we would have had a carrying value at the end of 23, on 31 December 23, of 40,000. Now, under the new method, we said that we are going to write off, let me show you that just quickly again, 18,333 for depreciation for the current year. That's a 55,000 divided by 3 equals 18,333. So that then gives us 18,333 depreciation based on the new method. Now, it's not rocket science to work out what is the impact on my depreciation charge for the current year. I would have passed 20,000 if I was continuing in the old method. I am now only going to pass 18,333 because I have a new method now, a new estimate. So what is the impact? My depreciation charge is going to be less with 1667. If my depreciation charge is less with 1667, that then means that my profits will increase in the current year with 1667. Now, according to IAS 8, that is not where I stop. I must also disclose to the reader of the financial statements what is this impact of the change in estimate on future profits. Now, going to the old method, we said that the carry value of this asset was 40,000 Rand at the end of the year. How much depreciation would we have written off based on the old method on this asset in the future, i.e. as from 1 January 24? 40,000, because there was no estimated residual value, we would have depreciated that asset in full. 20,000 still to come. So we would have written off in the future, based on the old method, 40,000 Rand. On the new method, we said, well, what is going to be our carrying value of the asset at the end of the year? 41,167. Are we going to write off the full 41,167 as depreciation in the future? No. We are only going to provide depreciation up to the estimated residual value of 5,000 Rand. Therefore, we are only going to write off in the future 36,667. Now, opposed to 40,000 that we would have written off in the future, 24 and 25 on this asset, we are now only going to write off 36,667. So we're going to write off less depreciation based on the new method than on the old method. And because the depreciation that we're going to write off is less, it will have a positive impact on our future profits. Now, let's have a look what is now our accounting entry in this year. In this year, we're going to debit our depreciation in our profit and loss. This is our expense account, 18,333. It's that 18,333. and we're going to credit accumulated depreciation in our statement of financial position, 18,333. Listen carefully. At what value are we going to disclose our asset at the end of the year in the statement of financial position? We're going to disclose it at the cost price of 100,000 Rand. Nothing has changed with the cost price. I cannot change it. This asset did cost me 100,000 Rand. 100,000 Rand. Less accumulated depreciation. The 40,000 that I've written off in 21 and 22 plus the 18,333 in 23. So what is my total accumulated depreciation? 58,333. 40,000 in the past plus the 18, 58,333. What is 100,000 less 58,333? 41,167. So the carry value of our asset as at the end of the year, 41,167. So if I've done my IAS 16 note, I've asked you to do that note with a change in estimate. Nothing is going to change with my cost price. The change is going to be affected in my accumulated depreciation and my depreciation charge for the current year. Good, let's have a look at the disclosure now. Now, guys, you can see here, this will be in our profit before tax note. Because you see the word there, tax, that then has the implication that that is a company. So we're going to, it's only companies is going to pay tax in their own right. So this will be, when we do IAS 16, you will see the other items that has to be disclosed under this note. So this is only the depreciation part of this note. We will say profit before tax was calculated after taking the following into account. Very important, you have to have comparative figures. If you don't, you will lose here at least 2 marks. You have to have comparative figures. Depreciation vehicles. Last year, how much did I write off? 20,000 Rand. Now, under that depreciation, we have to break it down into 2 batches. The one is the original estimate, which was last year 20,000, and if we did continue with the old method, it would have been 20,000 in this year as well. Then we want to see the change in estimate to derive at our actual depreciation charge for the year. So the 20,000 is the actual depreciation charge, the 18,333 is the actual depreciation charge. There you see, we've only passed 18,333 for this year. There is our impact on our profits, 1667. So if we did continue with the old way, we would have had 20,000 Rand depreciation. Now we have a new way, and now we only have 18,333. So in that little block there, next to depreciation, is our actual depreciation charge. Then we break it down in the original estimate, which is 20,000. The impact, change in estimate 1667, 20,000 less 1667 gives us then the 18,333. Then you also have to tell the reader of the financial statements what was the change in estimate all about. We say, well, during the current financial year, there was a change in estimate with regard to depreciation due to a change in the residual value of the asset from 0 to 5,000 Rand. The effect on the current year profit is an increase. Depreciation was reduced, so my profits has increased with 1667, and future profits will increase by 333. There's the 333. The difference between the depreciation based on the old method that we would have written off in 24 and 25 and the depreciation that we're going to write off based on the new method. You've also calculated that 36,667. You've said it's 18,333, 18,333, 18,334. 18,333, one we have accounted for, so what is left? The other 18,333 plus the 18,334, which gives us 36,667. So the impact, 3,333. So guys, let's just quickly recap then. the reallocation method. Where do we start? We start at the carrying value of the asset as at the beginning of the current financial year. That's our starting point. We forget about the past. We apply our change of estimate, our new estimates, based on the carrying value as at the beginning of the year. And we only look forward and we apply that from there on forward. What is important is that you also know what is the impact of the change on the current year's profits and what is the impact of the change on future profits. Good, let's assume that this entity has decided they are going to apply the cumulative catch-up method and not the reallocation method. Now the cumulative catch-up method says let's reinvent the wheel. We are going to take all these square wheels off our wagons and we're going to replace it with the round ones because it works better. Take a deep breath, pick yourself up, dust yourself off and start all over again. We're going to start all the way from the past and we're going to work all the way into the future. So what we're going to do is we're going to press the restart button altogether. Now, when we say that, what is the starting point now? The starting point is when we acquired the asset somewhere in the past. And we're going to redo all the calculations based on that starting point in the past by applying our latest estimates on that asset as if we have applied it from day one onwards. Good. Again, old method, new method, difference. So we're going to start here at the cost price of the asset. The cost price of the asset on 1 January was 100,000. We've written off depreciation in 21 under the old method, 20,000. In 22, old method, 20,000, which brought us to the carrying value of this asset at the beginning of the current financial year where the change in estimate took place of 60,000. Now we're going to do the same but based now on the new estimates. The cost price of the asset still is 100,000, but our depreciation charge based on the new estimates would have been different. It would have been, our depreciable value would have been our cost price of 100,000, yes, 1 0 too many, 100,000 less the estimated residual value of 5,000 divided by 5, which gives us 95,000 rand. Now, that 95,000 rand over a 5-year period gives us then 19,000 rand per depreciation per annum. So if we did apply it from the beginning, we would have written off in 21, 19,000, in 22, 19,000. So that means if we did apply the new estimates as from the start, the carrying value of the asset at the beginning of the current financial year. This is so important. Everything basically has to start really happening as at the carrying value at the beginning of the current financial year, because we can only affect changes in the current financial year. We cannot do anything about the 21 and 22 financial years. It's bygones. But we say now on the cumulative catch-up that our carrying value at the beginning of this year should have been 62,000 rand. Our financial statements only reflect 60,000 rand. So if we want to rectify the sins of the past, what do we have to do? Can we fiddle around with the cost price? No. Where did the change come about? In my depreciation. So if we want to rectify the sins of the past, what do we have to do? We will have to debit accumulated depreciation with 2,000 rand and credit our 23 depreciation charge with 2,000 rand. Then we've catched up the sins of the past, the 2,000 rand. So when we're actually going to affect this catch-up is as at 1 January 23. And if we pass this entry on 1 January 23, at what value would that asset then stand in our books? At 62,000 rand. So remember, what did we do? We debit accumulated depreciation. We credit the expense account 2,000 rand depreciation. Our depreciation for the current year is still 19,000 rand. So what are we going to do when we pass that entry? We're going to debit depreciation charge, 19,000 Rand, and we're going to credit our accumulated depreciation, 19,000 Rand. So what is the net impact of our entry? The net impact is that our depreciation is going to be debited expense with 17,000 Rand, and our accumulated depreciation is going to be credited with 17,000 Rand. If you have passed this entry in two entries, it is 100% correct, because then you have accounted for the catch-up and you've accounted for the current year's depreciation separately. Good. So, what is the impact on the current year's profits? How much depreciation would we have written off? 20,000 Rand. How much did we in actual fact written off? In actual fact, our actual charge that went through depreciation was 17,000. So 20 less 17 gives us 3,000 Rand. That is also the difference in the carrying value of the assets as at the end of the year. 43 less 40, 3,000 Rand. So the impact of this rectification is then a positive impact on our depreciation of 3,000 Rand. A positive impact on our profits. It actually reduces our depreciation. Now we also have to determine what is the impact on future profits. So based on the old method, we would have written off 40,000 Rand because there's no estimated residual value in 24 and 25, 20,000, 20,000, based on the old method. Based on the new method, we're not going to write off 43,000 Rand of depreciation in the future because we're only going to depreciate the asset up to its estimated residual value of 5,000 Rand. So we're only going to write off in the future 38,000 Rand. So therefore, in the future, based on the new method, we're going to write off 2,000 Rand less depreciation than on the old method. So this would also be a positive impact on our profits. Let's look at our disclosure. Profit before tax note. Profit before tax was calculated after taking the following into account. Comparative figures. Depreciation on the vehicles. 22 was 20,000. 23 is in total 17,000. There we had it. 17,000, 17,000, and that 17,000 can be broken up between the catch-up and the current year's depreciation. And it's very important that you understand that the 17,000 Rand actually has two components, because you will see in later more intelligent questions that you're going to get is I'm going to give you one of the two and you have to work out the other one. And if you don't realize that the 17,000 actually has two components, you're never going to derive at an answer. Good. So in that there is the actual depreciation charge. Our original estimate was 20,000. So therefore, the impact on the current year, 20 less 17 gives us 3,000. And that brings us also back to that 3,000 that we had there. 20 less 17 or 43 less 40. Good. Then our change in estimate note. During the year, there was a change in estimate with regards to depreciation due to a change in the residual value of the asset from 0 to 5,000 Rand. The effect on the current year profits is an increase of 3,000 Rand. Future profits will increase by 2,000 Rand. That 2,000 Rand, oopsie, that was that last 2,000 Rand there. Let's just get this back. Oh, now you see it all over again. So what's the cumulative catch-up method? We start all over again. So where do we start? At the acquisition date. What do? We work it out in the old way and in the new way. Future profits is the future depreciation. That is after 31 December X3. What are we going to write off? Based on the old method and the new method. And that is where that 2,000 Rand positive impact on the depreciation on the profits is going to be after 31 December 23. So, quickly, if we can recap then again, cumulative catch-up is that I have to work out what was the sense of the past. So therefore I start at the acquisition date of the asset. I redo all the calculations as from the acquisition date based on the new estimate by carrying values based on the old method, and the new method as at the beginning of the current financial year will be our catch up, and that we have to rectify based in our current financial year, in the year when the change in estimate took place. Then based on the new estimates, I'm going to calculate what is my normal depreciation for the year, and that will be the other component of my depreciation charge for the year. So that was then 17,000 in total. Good, guys. What do you call a 90-year-old accountant? Someone at the end of their useful life. We are far from that. Make 100% sure you understand these two methods of calculating changes in estimates. Make 100% sure you know exactly how to disclose it, not your own invention, not what you think you should do, exactly what it should look like, because it's prescriptive by IAS 1 and 8. So it has to look exactly the same, not your own interpretation. Then you're not going to receive one single mark for that. Good. And then you're going to receive this in all the papers right through the year, either as part of a cash flow statement, either as part of a company's question, either as part of an IS1 question, or on its own. So extremely, extremely important that you understand this topic very, very well.